Bitcoin just hit its lowest level in a year, and every time this happens, the headlines start flying. Institutions are dumping, crypto is dead. This time it's different. But if you've been through a few cycles, you realize that this move is actually very consistent with how Bitcoin has behaved historically. So today I want to walk you through this calmly, not emotionally. What we're going to do is we're going to look at number one, where are we in the 4-year cycle? Number two, what cyclicity is telling us right now. Number three, why institutional demand didn't stop the drop. Number four, where structural support actually sits. And finally, number five, what traders should realistically be doing right now. So this isn't about predicting Bitcoin prices, but more about understanding the actual market structure. Hi, I'm Justin from Vincere Investment Academy, and I've been trading through multiple crypto cycles like this one. Bull markets, crashes, and long periods of boredom. And one thing is consistent. When prices move like this, it's never random. By the end of this video, you'll understand why prices move the way they did and what you can do next immediately. Now, Bitcoin crashed because the 4-year cycle is playing out exactly as it should. Every 4 years, Bitcoin goes into a halving, meaning that supply gets cut in half. You get roughly 12 to 18 months of bullish expansion, followed by a period of about a year of cooling or contraction. Now, you track the most recent halving and you measure forward 18 months, you'll notice something very uncomfortable. The peak actually happened in October 2025. And that means right now we're in this timing of a window where the bear market is actually happening. That means what we've seen recently wasn't just a pullback, and we're actually in the middle of a bear cycle. So historically, this bear cycle usually lasts about 1 year. So it's very important to understand that once the cyclicity shifts to the downside, your bias should also shift with it. Most traders lose money because they emotionally anchor to the previous trend. They keep saying, oh, it's just a dip. Oh, it's going to bounce and it's always going to recover. And eventually for Bitcoin, it does, but not before it completes the entire corrective phase. And if the market right now is structurally printing in lower lows and lower highs, you don't want to fight that. What you want to be able to do is to trade in the direction of the trend, and you cannot argue with the market structure. If you feel like you've been through the cycle and things are repeating itself, your portfolio is blowing up and you find yourself lost, it isn't because of your lack of skills. It's actually completely normal. You just need to recognize the pattern and make the appropriate steps. We've actually put together a free ebook that breaks down how profitable traders manage fundamentals, risk, and execution together. If you want more clarity on trading patterns and trading psychology that will help you start becoming profitable consistently, then check out the free ebook that is linked in the description below. It is designed to help you map out your habits, identify the gaps, and start aligning your actions with actual results. Now you might be wondering, but institutions bought. Why didn't that save the market? Which brings me to part 2. So the key thing to understand is that demand alone doesn't move price up forever. Yes, demand did increase, but here's the missing piece. Supply also increased. What happened in this cycle that was very different from the past other cycles was that a lot of the early holders, the early adopters, what we call the OG wallets that have been dormant for many years, actually started moving and actually started to sell out some of their holdings. And so when institutions bought, the people that were selling it to them were actually those people that have held from the beginning. And there was actually a change in the ownership. So when prices rallied aggressively into institutional demand, the long-term holders actually distributed into that strength. So if the supply absorbs demand, then prices stall. And then you layer that with something else on top. When margin requirements get tightened, or when volatility spikes, over-leveraged positions get liquidated. And the liquidations are not gradual. They actually cascade very quickly. So what actually happened was there was a supply absorption and there was also a leverage unwind. And that combination actually created a sharp downside acceleration. And this is simply structural market mechanics. Now let's talk a little bit about the structural mechanics and where are the price floors and where is the structural support. And what does that even mean? Structural support is a price level where a majority of the long-term holders are not losing money. It's where the market's average cost basis sits, which we call the realized price. When the market approaches that level, selling pressure naturally slows down. Why? Because most people are either number one at break even or number two still in profit. And when people aren't in pain, they don't panic sell. And that's structural. Now in Bitcoin, there are two major reference points historically. The 200-week moving average, that is basically the long-term trend line that has acted as a floor in previous bear markets. And number 2, the realized price. This is the average price that all the coins in circulation were last moved at. In simple terms, the market's average purchase price. When price drops towards the realized price, you're approaching a zone where the average investor is at break even. Because below that level, the majority of holders are actually underwater. And historically, Bitcoin does not stay below that zone for very long. Sustained trading below the realized price is rare. And right now, that structural zone is roughly around the mid 50K range. Now, could price dip below temporarily? Yes, but what matters is not the wick. It's whether price can actually hold below that level for weeks. Professionals don't ask, is this the bottom? They ask, are we approaching structural value? And that is a very different mindset. You cannot and you will never be able to catch the exact bottom. But you realize that, hey, right now we're at a discount, prices are cheap, and prices are unlikely to stay depressed for very long, then that is the levels that you want to be looking at. Now, if you want to see how professionals actually identify where the key trends are at, what levels that we actually trade from, what is the time frame that we're looking at, how do we manage our risk, and how do we build our overall portfolio so that it's crisis proof and we're able to actually take advantage of both bull markets and bear markets as well, we've linked a free training in the description. This is the same framework that is taught at Ventura Investment Academy, where over 4,000 traders worldwide have been trained, and it walks you through how to trade with clarity, control risk, and make decisions more consistently instead of relying on guesswork. Now, this is the part where most people don't want to hear. If the cyclicity is down, you don't blindly call reversals. You wait for confirmation. What it looks like is you want to see higher highs and higher lows and uptrend cyclicity coming back. Until that happens, any bullish thesis is early, and early means you're wrong. In terms of trading short term, make sure you respect the direction of the structure. If you're shorting, take positions near major support levels. Don't get greedy into the structural floors. If you're investing long term, allocate gradually. Don't go all in emotionally just because price dropped 10 to 20%. Bear markets are actually not disasters. They are liquidity resets, which typically means they're opportunities. The traders who actually survive the cycles are the ones that stop fighting the market structure and they actually want to follow it. The best traders are able to maximize their profits in an uptrend, but when the market comes, they're able to actually make more money in that 1 year than in the past 4 years combined, because in a bear market, that's where prices crashes fast, and that's where you're able to make even more money. And when the cycle turns sideways, that's where you're able to trade in and out on different levels and capture profits in a sideways market as well. So if this is your first cycle, it might feel dramatic. But if this is your second or third, it might feel very familiar. Bitcoin isn't dying, but the bull phase might be over for now. And understanding that difference is what separates structured traders from emotional ones. The market isn't random, it's cyclical. And the big question is, are you trading the cycle or are you trading on emotion and just reacting to it? The key takeaway is that prediction is meaningless. We can all predict where price is going to go, what Bitcoin is going to be in the next 5-10 years. But the most important thing in order to be profitable is to understand where the cyclicity is, right? Trade together with the trend and make sure you're following and respecting market structure. If this video has added value to you, do check out our free resources that the team has prepared, our ebook and the training which I mentioned earlier that are linked in the description below. Make sure you register and get those resources. They will give you a practical walkthrough that shows you how to trade systematically and confidently. If you have any questions about Forex, crypto, or commodities trading, then leave a comment below and my team and I may feature it in our next video. Don't forget to like, subscribe, and hit the bell so that you don't miss out on more actionable insights. And I'll see you in the next one.